At this time, I'd like to introduce our next two speakers, and that will be Dr. Ted Schroeder and Jim Mintert, and they're going to share some of their thoughts on the biofuels industry and what that means for all of us in the cattle business.
Thanks, Justin. It's a pleasure to be here. Appreciate the opportunity. As Justin said, we're going to talk about corn, cattle, and something I can't pronounce. Dr. Schroeder put that on the slide, so you'll find out later what that's about. Let's talk just a little bit about what's going on in the corn market. Our corn supply-demand balance is tight, and it's going to remain tight, I think, for the foreseeable future. 2007, we had record large production, 13.1 billion bushels. If you start tracing through some scenarios for 2008, you're going to conclude pretty quickly that we'll probably have near record production in 2008. Acreage is probably going to be down a little bit compared to last year, but would still be the second largest on record, or second largest since the end of World War II anyway. Trendline yields gives you a number pretty close to 13 billion bushels. So we're going to have a big corn crop again this year, but we have tremendous corn usage keeping those corn stocks very, very tight. And of course, the big driver of this is really what's taking place in the ethanol markets. This gives us a picture of bushels of corn going into ethanol production starting in 2002. That was the first year USDA actually reported data on a separate basis for ethanol. 2002, we put 1 billion bushels of corn into ethanol production. That ramped up very quickly to over 2 billion bushels coming out of the 2006 corn crop. The 2007 corn crop, USDA is estimating that we'll put 3.1 to 3.2 billion bushels of corn into ethanol production. And if you start thinking about what's taking place right now with plant construction and looking ahead to the 2008 crop, we're probably going to see over 3.5 billion bushels of corn going into ethanol production. If you look around the industry, some people are actually suggesting we could see as much as 4 billion bushels of corn going into ethanol production coming out of the crop that we'll harvest in the fall of 2008. So tremendous demand for corn coming out of the ethanol sector. That is not the only thing that has been growing over time, and I think it's instructive to just look at total corn usage going back over the last 3 decades or so, and that's what this slide does. U.S. total corn usage, all categories, going back to the early 1970s. You look at the early to mid-1970s, we were using on an annual basis between 5 and 6 billion bushels of corn. And you can see how it's changed dramatically over time. That blue line is the actual corn usage on an annual basis. That red line is the trend. And as you look at the right-hand side of that slide, you realize what's taken place with ethanol. We took what was already a strong upward trend in corn usage and caused it to simply blow right through that trend line. And you look at where we're at right now with total corn usage in the ballpark of about 13 billion bushels. So a dramatic change over time in terms of that long-term trend, and then ethanol has caused us to really kind of blow up or blow through that trend here more recently. Another way of looking at that same data, which is also instructive, is looking at the individual usage categories of corn, and that's what this slide does. And I've broken it out, looked at 2 of the big categories. Traditionally, feed usage, our largest usage category for corn, and you go back to 2002, about 62% of our corn crop was going into feed usage, going into the U.S. livestock sector, and only about 11% of the corn crop was going into ethanol production. If you look at projections for 2008, at least some very preliminary ones that I was putting together based on some of the data USDA has available and some of my own projections, it looks like we'll be in the ballpark of about 29% of the crop going into ethanol production, and only about 44% going into feed usage. And you start thinking about growth in ethanol usage in the future, you can project when those 2 lines are going to cross sometime in the not too distant future, or at least those 2 bars becoming equal as we move forward. Well, if you walk through 2008 and start thinking about how large ending stocks are going to be, and then expressing it as a percentage of usage, which is what I've done on this slide, and what that does is it allows us to compare today's corn market to corn markets of the last several decades, even though the industry has gotten much larger. So instead of just looking at the raw carryover numbers, look at it as a percentage of total usage. And then start projecting where we might wind up in the summer of 2009 before we get ready to harvest that 2009 corn crop. We could see ending stocks as a percentage of usage, even with trendline yields of 156.7 bushels per acre, which is about 5 bushels more per acre than we harvested last fall, even with those kind of yields, we could still see ending stocks in the ballpark of about 10% of total usage. And in fact, it could easily fall below that if we have yields back off just a little bit from what I'm projecting at the moment. So as you look at that, you can see that the tight corn stock situation is not something that's going to go away rapidly. And this is much different than what we've been acclimated to in agriculture for most of our lives. Most of our lives, we've been acclimated to the idea that when we have a tight corn supply situation, it's been caused because we had a crop problem, a crop production problem, and we normally rectify that in 1 year's time with a return to normal weather patterns. This is being driven by very, very strong demand in general, and especially coming out of the ethanol sector. So it's not going to go away rapidly, and so we're going to see tight corn supplies and relatively high prices for an extended period of time. This is monthly average corn prices in Kansas going back to the mid-1970s, and I've just computed a few arbitrary 5-year averages for you just to kind of put things in perspective and let you know how different things are right now. The late 1980s, we averaged, I think, 2.25, 223. Early 90s, we averaged 240. Late 90s, 265. First 5 years of this decade, we averaged 223. 2006, we averaged 240. Boy, things change in a hurry, don't they? Because 2007, we averaged 363. What are we going to average this year? Probably going to start with a 4, right? So a dramatic change. We are really outside the boundaries of what we've been acclimated to. And as you look at that chart and think about it from a cattle feeder's perspective, for example, we have tended not to worry very much about input price risk. We've tended not to worry very much about feed price risk. And as you look at that chart, except for a couple of time periods, that wasn't such a bad decision, right? That wasn't such a bad decision. Mid-1990s, we, of course, had a short corn crop and ratcheted up corn prices pretty dramatically in the spring and summer of 1996 and saw monthly average prices approach $5 a bushel. But that time period and the one we're in right now are really the two time frames in that chart where not paying attention to feed price risk really caused a problem. Going forward, we're going to see not only high average prices, but we're also going to see tremendous volatility. And we've been seeing that here this winter. I don't think that's going to go away anytime in the near future. So as cattle producers, as cattle feeders, we're going to have to be much more aggressive about managing feed price risk than we have in the past. That's a big change for many of us in the industry, but I think it's one that's going to be critical to implement as we go forward. So let's talk a little bit about where we're headed here. The industry, from a long-run perspective, has seen production costs ratchet up dramatically. And that means, as an industry, eventually we're going to have to see some higher prices, right? We can't survive as an industry simply by letting our costs go up dramatically and getting the same prices we've had in the past. Let's talk a little bit about some possible sources of higher prices. What about beef demand? Domestically, we have two demand sources. One's domestic, which is over 90% of the beef market. The second one's the international market, which is growing in importance again, following our drop-off with BSE in late 2003 and 2004. But the key growth markets, the Pacific Rim markets, I think are still in question. So we're seeing some growth in the export markets, but it's going to be tough to see dramatic growth in the short run. This is the retail beef demand index that I maintain on behalf of the Beef Board. And as you look at the numbers, you can see what's taken place there. We've seen a nice little resurgence in beef demand starting in the late 1990s, following a long period of decline. And then as you look at 05 and 06, you could see we were losing ground with respect to the prior years. We were looking at, I think, about 5 and 6% declines in beef demand in 05 and 06 compared to a year earlier. 2007 data essentially says that beef demand held about steady with the prior year. And as I look at the data, I think it's going to be tough to see very much growth in domestic beef demand in, say, 2008 or possibly even 2009. So in terms of a source of higher prices, I'm not terribly optimistic that we're going to be able to bump up domestic beef demand enough to get very much help on the price side from that perspective. The export side, I'm a little more optimistic on. This is a graph of U.S. beef exports going back to 1980. And you can see the dramatic growth we saw in meat exports in general, beef exports in particular, throughout the 80s, especially the 90s, and then, of course, plummeting after the BSE event in December of 2003. But you can see the recovery coming there as you look at 05, 06, 07, and a projection for 08. But notice that that projection for 08 still leaves us well below where we were in 2003. So we're going to struggle, I think, for a period of time in terms of getting those export markets back. If you look at it, what's taken place there, the key, obviously, is those two key Pacific Rim markets, Japan. This is Japan's share of U.S. beef exports going back to the early 1990s. Some recovery taken place, but in 07 was, on a quantity basis, only taken about 10 or 11% of our exports, whereas prior to BSE, Japan was taken between 30 and 35%, and in some years actually a little over 40%, depending on which year you look at. If you look at Korea, similar kind of a story. Before the BSE event, Korea was one of our best success stories in terms of rapid growth. We were shipping between 20 and 25% of our beef exports to South Korea prior to BSE. Negligible the last several years. A little bit of a rebound in the last half of 07 as we finally got the door open a little bit to that market, but still only taken about 5% of our beef exports last year. Going forward, I expect to see some growth in both of those markets, but it's going to be a challenge. It's going to be a challenge. If you look at it, I think a lot of people have looked at the fall in the value of the dollar and are looking to that to bail us out, and I think there is some help there. As you look at the Japanese yen per U.S. dollar, you can see the value of the yen or the dollar coming down relative to the yen over time. That is providing a nice little boost in terms of an additional incentive to move more product to those markets. But the key really isn't what's going on the economic side. The key is really what's taking place from a government policy perspective and also from a consumer perspective. Dr. Schroeder and I just completed a survey work last year looking at survey results from consumers at several different countries around the world. One of them was Japan. And one of the things we really concluded looking at those survey results was how much different Japanese consumers really are than North American consumers, especially U.S. and Canadian consumers. They really do have some deep-seated concerns about beef food safety that U.S. consumers don't have, and they have some deep-seated reservations about the safety of U.S. beef in particular. So even once that door opens from a policy perspective, it looks to us like it's going to take some time to rebuild those export markets. Same kind of story with respect to Korea. From the currency standpoint, looks very good in terms of making U.S. products cheaper in those importing countries. That should be beneficial to exports from a long-run perspective, but I don't think it's going to be that beneficial in the short run because we have other impediments to growth in exports. So let's talk a little bit about the implications of the dramatic rise in production costs. We just walked through the demand side, and I just said that we're probably not going to get very much help out of the domestic demand side. We might get some help from the export side. In fact, I think we will get some help, but probably not enough to offset this dramatic increase in production costs that have taken place. So how is this industry going to obtain higher prices, stronger domestic beef demand? I don't think we're going to see enough growth there the next couple of years to offset the production cost rise. Export demand, yeah, I think we're going to get some help there, but not enough to completely offset what's taken place from production cost rise perspective. So what does that mean? How is this industry going to get higher prices? We're going to wind up selling fewer pounds of beef to U.S. consumers, and when we do that, we're going to get higher prices. So the answer, unfortunately, I think, looking ahead, is industry contraction. And the result's going to be a smaller industry providing consumers fewer pounds of beef, and they'll wind up paying more money for it, but not until we provide them fewer pounds of beef. I'd argue that some of that's already underway. This is the beef cow inventory going back to the mid-1990s. Got the January 1, 2008 data on there. You know, we were down a little over 2 or 3%, I think, on the beef cow inventory. The total inventory down about 1% compared to a year ago. So I think we did see some liquidation take place during 2007. I think we're going to see more liquidation take place in 2008 and 2009 as we head towards a smaller industry that's probably going to supply a smaller number of pounds of beef to U.S. consumers which will give us higher prices. But that's going to take some time, and it's not going to be a lot of fun for a lot of us in this room, unfortunately. So, Ted?
Gosh, with that uplifting, optimistic story, Jim, let's see where I can take this group. Yeah. Yeah, anybody got a good joke? No, seriously, I don't do that anymore because usually somebody does, and I usually get in trouble for that. But it is wonderful to see the young folks here today. I did a survey as I was looking around the room, and 3/4 of you are under 35. I can tell just by looking around the room. I'm not going to tell you which 3/4. You probably know. But indeed it is a good thing to see you here, because the challenges Jim just described, I'm going to describe a few more as we look forward. Some of the interesting developments going on in the industry that are quite current and that have significant impacts on where we're going in this industry. So you young folks, it's up to you to figure out how to navigate through this thing as you go forward, because the rest of us are just going to kind of watch it. But as Jim said, the cow herd contracting, the entire industry shrinking a bit, it's not a new phenomena. Since the start of the decade, we have lost on a weekly basis about 60,000 head of cattle per week that are no longer around in our industry. Contraction of the industry has already been going on for a while. Based on what you've seen from Jim's description and what we know about what's happening with the grain markets and so on and so forth and the cow herd, what do you think the trend line's going to do the next year? Any guesses? I don't think it's going to turn around and go the other way for a while. So as an industry that's facing those kind of challenges shrinks down a bit to get the supply back in line to where people can be profitable more consistently, what happens to an industry when that occurs is those segments of the industry that have a lot of fixed assets invested in this industry that are uniquely suited for certain things start to see some restructuring. And when you have a decline of that magnitude that's that long of a time period that we've seen with this slaughter per week and no end in sight for at least the next year or two perhaps, in terms of the trend and the pattern, the packing industry is one in particular that may restructure at that phase. They have had a very tough time here of late. This is the packer margin, which is simply what they sell beef and byproduct for minus what they pay for cattle. So it's a gross margin, doesn't include the costs associated with operating their business. And you can see, first, long term, we're at about the same margin levels, roughly, that we were when this decade started. Maybe more importantly, really downward, quite dramatic downward from where we were only about a year and a half ago. And again, remember that given trends, where's this thing likely to go? If you're a packer sitting there who's had a bath lately in terms of revenue opportunities and in terms of profitability, and you look forward, it's natural you may not be too optimistic either. Remember, margin gross about the same as we started the decade. Look what's happened to costs. Here's the cost of energy has almost doubled during that time period. As we know, beef processing is a very energy-intensive activity. So an input cost that's very important in the process has nearly doubled. Wage rates in the industry have gone up 20% during the same time period. These are some long-term structural sorts of dimensions that the only way you can recapture these is through increased gross margins. And the gross margins, as we see, have not been able to increase. So that creates some opportunities for those who may want to get in the business, or you can say it creates enough pain that maybe some get out. And so we already have seen here in Kansas that Tyson decided that the plant in Emporia was not worth keeping at a full slaughter capacity type of operation. That's a reflection or reaction to this, looking forward saying where we're at doesn't look like it's going to improve for a while, then why does suddenly somebody from Brazil come into our industry and find it such an opportunity? Right? If somebody's getting out, somebody else must want in this industry, and indeed, JBS Swift has come in a very big way, in a very quick fashion. Well, it's not just coincidental that JBS is out of Brazil and interested in U.S. firms and the U.S. industry. Since 5 years ago, January 1 of 2003 to today, for them, our industry became half price because our dollar was declining in value while the real was increasing in value, where over 5 years this became a half-price deal. It's a very opportunistic time for someone to come in from that sort of an economic framework where their real is worth a lot more than it used to be per dollar, or the dollar's worth a lot less than it used to be per real. Our industry is struggling some, so the sellers are willing to sell, and the buyer has more cash than he had before relative to our dollar. So it is logical in many ways that someone who has a bargain like that in front of them and has desire to enter the industry in a global fashion much larger than they already are, that this represents an opportunity for them. Well, what does it do to our industry structure when a large player comes in who is already number 3 in our industry and adds number 4 and 5 to their firm structure? Now, this is all proposed yet, right? This has to go through some Department of Justice scrutiny, but we suddenly take, and I've adjusted this Tyson number down because of the Emporia plant closure. I don't know if these numbers are exactly accurate, but they're close. We take 3, 4, and 5, and we combine them and make a very large single firm compared to where we were. Now, let's just look a little bit at the geography of this. The green stars here are the combined Swift, Smithfield, and National plants, the new JBS conglomerate. The blue here are where the Tyson plants are, and the red diamonds there, the Cargill or Excel plants. So we've certainly still have places where there's all 3 players competing. And there's certainly some trade-offs here. And we got to be real and honest and assess these trade-offs and evaluate them if we're going to take a perspective on whether this is good or bad. Because this has both good and bad dimensions to it. Or at least potentially good and bad dimensions to it. We don't ever even know fully the answer of whether all the goods outweigh all the bads. But we know there's potential for some of both. Certainly when you come in and have a large player become much larger, we do have concerns about market access, about market power, about oligopsony power, and about firms being able to actually influence price by their decision making. That can be a problem for someone who's trying to be a customer to them. And so that raises some concerns. Will they take advantage of that market power? However, what are some of the pluses to this? Well, clearly one that drives these decisions, we already saw that we had packing plants or firms in the U.S. that were saying we're not having that much fun doing this anymore. What would have been or could have been or might be the next plant that says this isn't worth it? Do these guys coming in enable us to keep some plants open that would not have been otherwise? I don't know. It's a possibility. Do these guys coming in and merging create some economies of scale that create some cost savings that can also offset some of the market power imbalance? There are trade-offs. Which one dominates, I don't know. And which one is even a concern, I don't know, but there clearly are potential trade-offs both directions. If we look a little more, the Department of Justice, as we said, will actually scrutinize this merger. And the Department of Justice uses what's called a Herfindahl-Hirschman index as a measuring stick to determine whether they should do something or not when a horizontal merger occurs. And in particular, in this industry, depending upon how you define the market, meaning whether it's all cattle slaughter or whether it's just steer and heifer slaughter, under Department of Justice guidelines, right now, operating prior to the merger, the all cattle slaughter, cow slaughter as well as steer and heifer, would be in the moderate concentration level, stepping up to what the Department of Justice calls a concentrated industry. If it was just steer and heifer, I don't know what exactly this number might be, but it's a similar increase and would definitely come under scrutiny. Either case, this merger is going to be under Department of Justice scrutiny. They are going to evaluate it closely. It is going to have to be justified. JBS is not simply going to be given a blank slate to do what they wish. It will be under scrutiny. And the assessment comes down to the same assessment that I just sort of described. Will the benefits outweigh the potential adverse impacts? So that's a long discussion and dialogue and investigation to complete that full assessment. And where that comes out, I don't know. But clearly it's enough concentration and a substantial increase in concentration enough to get someone's attention to look at this more closely. Let's look at the other side of this, is the JBS purchase of the cattle feeding segment of Five Rivers, which ends up being a substantial vertical merger, not just the horizontal, but now coming in also and purchasing feedlots that are affiliated with this packing operation. And if all of Five Rivers' 10 feedlots supplied all of their cattle just to JBS plants, then somewhere, depending on how you want to measure which plants it's likely to supply to, somewhere, my rough calculation says between 15 and 20% of JBS's annual slaughter could be sourced from their own feed yards. That means the other 80% is going to be from cash market trade or whatever else, marketing agreements, other types of merchandising from other owners. So that's what my estimation says is roughly the likely sort of packer ownership structure under this arrangement. And the reason it could be upwards of 20, it would seem to me, I kind of took these plants out saying they're on the fringe and said more likely the feedlots here in blue would source these packing plants, and that's when you get closer to 20%. If you bring in some of these smaller plants, it's closer to 15. But if you look at this, you certainly see a clear strategic complementarity between the feedlots and the packing plants. I mean, that has to be a major source of the business decision framework here being made, because those feedlots are located very close to the major, largest, most modern plants within this overall business at this time in the States. And it's clearly the heart of the cattle feeding region as well. So that's a very strategic decision, I think, to match and marry those two, which really was not the case before. Those feedlots were half owned by Smithfield, whose packing plants were back here and one down here. They weren't strategically very closely aligned. They will be under this new conglomerate firm. Well, let's just kind of summarize then where we're at here. Jim's talked about the corn cost and what that's doing to our industry and the cost increase that's creating. He showed that that domestic demand, we got to hold some hope and continue to put a lot of energy into increasing that, but it doesn't show lots of promise right now as a major expansion opportunity. The export demand, certainly one. We've got to continue to hope that the weak dollar will help us get more product over and that we can figure out ways to reassure consumers in those markets that are growing, Japan especially, maybe Europe, maybe JBS can get us in there. We got to hope we can continue to do that and put more energy resources there. But even that one we're a little bit uncertain about. So as a result, growing the industry is not likely. Shrinkage is likely to occur for a little bit yet. And with the shrinkage comes structural realignment. And that's really what we're seeing here. Is some structural realignment. Are we done? I don't think so. I don't know what the next one's going to be, but it wouldn't surprise me that there's some additional alignment before this thing's all over. So there's lots of challenges out here. But obviously, someone like JBS coming in says, wow, this is an opportunity. So that's always the case when an industry goes through some structural realignment, that there are opportunities in that industry. And I think players like this that come in with different mentalities and different perceptions and attitudes and perspectives and different accesses to different markets and information, it's going to be an interesting time. There's no doubt about it. It's going to be interesting. With that, Jim, any other comments? We're open to any questions, comments you have, so please go at it.
Can you make the assumption that no matter how high corn costs go, the ethanol industry will just keep going? Don't they have a limit where they say, wait a minute, this doesn't look good either?
I guess in his own way he answered that, right? Well, from a long-run perspective, the real key in the ethanol industry is the mandates. It's the mandated usage that drives the industry. Short-run basis, you can get into some negative margin situations and see some plants cutting back, et cetera. But the real key to the ethanol sector is the mandated usage levels. The energy bill signed by President Bush back in December pumps that up to 15 billion gallons coming out of the corn sector. Renewable fuel, I think 36 billion gallons, but 15 billion gallons coming out of the corn sector. We've got several years, obviously, before we hit that target, but that's really the long-run perspective. So ethanol is going to be a huge consumer of corn for the foreseeable future, because until you hit the mandated usage level in a year when the mandate's applicable, and we're not at that 15 yet, but when we get there, until you hit the mandated usage level, those corn ethanol plants become perfectly inelastic buyers for corn, meaning they can pay virtually any price until you hit the mandate. After the mandate is hit, then economics prevails, right? Then it becomes a question of what is the margin, what is a gallon of ethanol worth, and that obviously is going to be keyed off of what a barrel of oil is worth, et cetera. But until you hit the mandate, they are perfectly inelastic buyers for corn, or have a perfectly inelastic demand for corn. And that's really the key of this industry, and that's why the political debate keys off of mandated usage levels. When you put the mandates up there, then you can go out with some confidence and build a plant and be reasonably assured that you're going to have some positive returns down the road. So. Based on what I know now, I would say that I don't see him changing on the downside. Here's what I see as the potentially interesting situation from a political perspective. And that would be, what happens if we have a drought, right? What happens if we have a drought, whether it's 2008, 2009, 2010? What happens if we have a drought in this kind of a tight corn stock situation? Put that corn price chart I had up there, and I'd have to redraw the axes because we go right off the chart, right, in terms of prices. And when that happens, what happens to the livestock sector? At that point, you're looking at wholesale liquidation, not just in the beef industry, but also in pork and in chicken. And that creates the potential for a different dynamic in Washington. But without that, without something really major like that, I don't see that the rhetoric in Washington changing. And with oil over $100 a barrel, you're going to get a good case today that what we're doing is the right thing from some folks. So even though from the livestock sector's perspective, we're suffering in a sense, they're not really feeling our pain so far, and I think that's going to be the case until we have a drought, and then I think we'll find out what people really think. So somebody in the back had one.
Jim, don't we have to see a jump in kind of live animal prices, clear across the board, because we watched log jump here, got to be $6 and we watched that down to $1 price.
That is what has to happen, and I'll be honest with you, and Ted and I have had this debate. He's going to probably disagree with me here, but as I look at the deferred futures contracts, for example, October, December, and February of '09, those contracts have ratcheted up here recently, and in a sense, perhaps reflecting an expectation of some smaller supplies. But when I look at the numbers of cattle that we have out there now and start tracing them through the system, it's difficult for me to anticipate supplies declining that rapidly. And so from that perspective, I'd be a little bit surprised if we actually see those kind of cash prices come this fall and next winter. But down the road, that is exactly the mechanism, though. Our forecast is that we'll shrink the industry to the point that we get us back in equilibrium at these new higher production cost levels. But you've got to shrink the supplies first. And as I look at the futures market is either more optimistic than I am about how rapidly we might ratchet down supplies, or perhaps they are much more optimistic than I am about the export market, or maybe some combination of the two, and time will tell who's right on that. But as I look at those contracts, I see some people trying to anticipate that reduction in supplies, but we typically in the industry are not going to be able to pull the numbers back that quickly. And if you look at cow slaughter data so far, here in early 2008, it looks like we're on track to reduce the size of the cow herd in '08, but not a massive liquidation, at least so far. That's probably what's going to happen without a drought. So, Rich?
Water weights, cattle, hogs, it seems like they have not pulled back very much due to the great increase in corn price. Why?
Output prices, right? The output prices have been high enough to prevent it, but we're getting awful close right now, right? We're getting awful close. But if you look at 2007, that's exactly what happened. And really, there's some interesting differences between 2007 and 1996. And at the beginning of the year, I thought 2007 might look a little more like 96 than it turned out to be. But the big difference in '07 versus 1996, I'll let you answer this. A lot of you in this room lived through it. What was the big difference in '07 versus 96? Both years we had very high corn prices. In 96, we saw the spread between, for example, 5 to 6 weight steers and 7 to 8 weight steers collapse to zero on an annual average basis. There were some weeks when it was negative. We never saw that last year. We're certainly not seeing it this winter, right? We've actually seen those spreads ratchet out a little bit here the last few weeks. What's the big difference? Slaughter cattle prices in 1996 averaged about $67 a hundredweight. In 2007, they averaged $93 and change. That makes all the difference in the world in how we respond to those things, and it's the same thing with weights. But in the current environment, given where cost of gains are, given where fed prices are, we are very, very close to having a big change there. In fact, I was talking to one of the major feeders here not long ago, and that was exactly what they were looking at in their operation, exactly how long it was going to be before they started reducing the days on feed because of this changing relationship. But we haven't, even though we had high feed cost in '07, we really didn't have the economic incentive to reduce weights because the fed cattle prices were high enough to prevent it from taking place. Yeah. Well, we talked about that, and that is a plus. I mean, the devaluation of the dollar is supportive of exports. The problem we have there, at least in the next year or so, is the fact that the major impediment to export growth is political access to those two key markets in the Pacific Rim. And then secondly, our survey work would suggest that we've got a problem in terms of regaining the trust and confidence of those consumers. So, and I hope I'm wrong about that. I hope that if we solve the political problem, that all of a sudden we see a rush of exports. But I do think once the political problem is resolved, we would see exports ramp up, but I don't think we'd get back to the 2003 levels overnight. I think it'll take some time to recoup that. But once that gets going, you're right, I think the value of the dollar is a plus for the export market. And if you think about where we have the most potential from a long-run perspective, clearly it's on the export side. As I look at it here over the next several years, it's going to be difficult, I think, to see significant improvement in domestic beef demand. I think our growth opportunities are in the export channels, as consumers around the world see their incomes ramp up and they want more protein, more high-quality protein in their diets. So, yeah. That one is tailor-made for Dr. Schroeder. How high is oil going to go? Thank you.
It's going to go a little higher than it is right now, for sure. What's your guess? You know, I mean, it's such a difficult thing to assess because it is market-driven, but it's also controlled by a very small group of international players. And usage is not curtailing given the high prices yet, so I don't think we've realized the top, even close perhaps. But it's all dependent upon what the supply flow is going to be allowed to be. That's the best I can do for you. I can't give you a forecast with any accuracy because I haven't actually looked that far either. Yeah, the question, well, you know, you can broaden the question. The question relates to how much can we ramp up our own production to meet our own oil demands. And really, we've sort of tried to take the strategy of also include with this the bioenergy component to hopefully substitute a bit. I mean, I'm not going to contend that I'm a global oil market expert, but darn little, maybe damn little is a better term. We don't have a lot of oil reserves relative to the rest of the world. We've got some, and we're tapping them, but we don't have the reserves, at least as far as I'm aware, relative to the rest of the world. And we certainly are only going to displace a small amount with bioenergy for at least the next decade. And you know, unless technology does things that I can't anticipate, which so bottom line, unless we curtail demand somehow, our supply sources are already constrained and already strained heavily, my opinion.
I'm just going to add a little bit to that. First of all, based on that forecast, I predict his next pickup truck has a smaller engine than the one he has now. The second thing is, if you think about the oil markets, it's really a tale of two markets, a short-run market versus a long-run market. In the short run, it's a market that's characterized by extraordinarily inelastic demand, not unlike what we see with food. And so, as a result, you get these big price swings in a short-run perspective. If you think about it from a little longer-run perspective, though, the supply of oil that's available out there, the quantity supplied to the marketplace potentially is much larger at $100 a barrel than it is at, say, $40 or $50 a barrel. But it takes quite a bit of time for that to be tapped into and realized. So you can get these big swings in the short run, but you look out into the future, and if we have a perception that we have a new long-run equilibrium price for oil that is indeed, I won't say necessarily $100, but somewhere in that ballpark, all of a sudden, over time, you'll see people starting to make investments that reflect that, and we will see a change in the supply situation. And that's, to some extent, we saw a little of that in the late 70s and 80s when we ran prices up the last time. We'll see some of that again this time, but it's going to take some time. It's not something that corrects itself or changes very quickly. Next one. We didn't survey Korea, but we did look at Japan. Well, that gets into kind of an interesting debate about what the Japanese actually asked for. And so I've been involved in some debates with some officials that engaged in some of those negotiations, and I guess there was a credibility question as to whether or not that would have really given us access. But from a long-run perspective, the industry is going to have to think long and hard about how we go about regaining the confidence and trust of those consumers. And that's not something that's going to happen overnight, at least based on our results and some of the other data that I've seen. So I'm I don't want to be too negative about that, and we'll get an empirical test, I suppose, at one point when we actually open the door and we find out for sure what consumers over there think when they get to vote with their pocketbooks. But anyway. Yes? Well, there's a lot of research underway, including some pilot projects to try and make ethanol out of some other things like cellulosic ethanol. The challenge for us in the cattle industry, though, is that really a good thing for us? I mean, the economic advantage of the beef industry has been to some extent, has been our ability to convert some relatively low-quality forages that are not usable elsewhere into pounds of gain. If we lose that source, that's not so clear that that's a positive for us in the beef industry. So there's some questions there, but all of a sudden you create new competition for hay and forages and other feedstuffs that traditionally haven't had much use except through the cattle industry. You create a competing demand for that, and I'm not positive that leaves us in a net positive situation in the livestock industry in general, or beef in particular. Let's take one more, and then I think we should break for the sale. Question was, can I comment on how consumers are allocating their pocketbook, so to speak? Clearly a challenge. I think as I look at the data for 2007, looking at the beef demand index data, I was encouraged that beef demand held up as well as it did in 07, given exactly what you're talking about. Relatively large competing meat supplies, tremendous competition on the energy side of the equation, and in the last quarter of the year, at least some softening in the economy. Now, we're not in a recession then, and nor are we now, as best I can tell looking at the data, but still not growing very rapidly. So in that context, I was encouraged that domestic retail beef demand was essentially holding its own with a year earlier. So that's the good news. But as I look ahead to 08 and even out to 09, those are some of the reasons, not the only ones, but those are some of the reasons why I'm not willing to forecast a return to the growth era in beef demand that we saw in the early part of this decade. We had several years in a row with very positive growth in domestic beef demand. I don't see that happening in 08 or 09, and what you brought up is just, those are some of the reasons why. So, thank you very much. We appreciate the opportunity to visit with you. It's been a pleasure. Thanks.